Last up, I'd like to welcome Chuck Rodell, Senior Vice President at Town Bank, who will come to the stage to introduce our speaker.
Good afternoon. Again, my name is Chuck Radel and work at Town Bank. Town Bank's part of the Wintrust holding company bank. There's 15 banks in the corporation, and we have our Chief Investment Strategist coming to speak to us today. So Jason Turner is the Chief Investment Strategist for Great Lakes Advisors, which is a Wintrust wealth management company. He's a member of the firm's investment committee. He authors market and economic commentary. He regularly presents in the media and at professional conferences, and he works with client portfolio managers to help our institutional as well as private clients. As the head of the multi-asset strategy investment team, he's responsible for our portfolio strategy, the asset allocation, and for overseeing the firm's manager due diligence and selection efforts. Jason holds a BA from North Central College, his MBA from DePaul's Kellstadt Graduate School of Management, and he is one of the first global recipients of the Yale School of Management and EDHEC Institute's Certificate in Risk and Investment Management. Prior to joining Great Lakes in 2009, Jason served in various roles for Skyline Asset Management and then Aon Hewitt Investment Consulting. He started in the industry back in 2001. Jason lives in the Chicago area. He's married and has a 15-year-old son and 10-year-old daughter. Both of them are swimmers. So those that know about the swimming experience knows that he gets to sit for long periods of time waiting, and then you have your 1 minute to watch your kids swim. So again, Jason came last year. He gave us his perspective. We get to hear again this year what his perspective is on the economy. There's been a lot of noise out there. So he's going to put his analysis in a way that's understandable and meaningful to listeners, and for listeners of all levels. I know you'll find Jason interesting, fun, and relatable. Please give a warm Rotary welcome to Jason Turner.
Thank you all for the warm welcome, for having me back, even if it's cold outside. Today's economic presentation is titled The Economic Picture According to Buffett. When I say Buffett, or anybody in the investing world says Buffett, you generally think of Mr. Warren Buffett, one of the greatest investors of our time, the founder of Berkshire Hathaway, recently lost his compatriot Charlie Munger last year, but he's a quote machine, full of a number of interesting quotes, and I promise these get a little funnier as we go. The first one, be fearful when others are greedy, greedy when others are fearful. Pretty common sense advice. Someone's sitting in the shade today because someone planted a tree a long time ago. Risk comes from not knowing what you're doing. Fairly statement of the obvious. It's only when the tide goes out that you discover who's been swimming naked. See, they get funnier. And no matter how great the talent or effort, some things take time. You can't produce a baby in 1 month by getting 9 women pregnant. And our final quote, Mother, Mother Ocean, I have heard your call. Now, those of you astute in the room realize that that last quote is not Warren Buffett. And in fact, our Buffett economist for today is Mr. Jimmy Buffett, someone who's left an indelible imprint on my life, having attended about 30 Jimmy Buffett shows. He passed in 2023, and I thought we would extract from his lyrics some economic insight. And yes, he actually used economic terms in some of his lyrics, and you'll see some of them here. First one from the song He Went to Paris. Some of it's magic, some of it's tragic, but I had a good life all the way. Aptly describing the state of the American economy. And we saw quite a significant consumer-driven recovery in 2021. We saw some troubles in early 2022, a couple of quarters of negative growth, one spurred by Russia's invasion of Ukraine and an upset to global trade. And the second quarter spurred mostly by a disruption in inventories. But as we've proceeded through 2023, a surprisingly strong American economy. Our last observation of 4.9% annualized GDP growth in the third quarter of last year, quite surprising, and even more surprising that big dark blue bar indicating that it was American consumers who really drove that economic growth. Now, if we look at GDP as our measure of growth, it looks awfully strong. We look at a different measure of growth called GDI, or gross domestic income, instead of measuring production, we're measuring the amount of money made by Americans and available to be spent. That growth isn't quite as outstanding. In fact, 2 of the last 5 quarters have been negative, and we have seen that number trend just above 1%. So the argument here would be, by different measures, the economy may not be as strong as it is on the surface as it is for individual Americans. And we think we can all appreciate in our daily lives that the current state of the American economy is being felt differently depending on individual circumstances, both for businesses and consumers. We'll walk through that in a little more detail. And I told you Jimmy used economic terms in his lyrics. I got quarters of my loafers trying to fight inflation when it only used to take a cent. We've talked an awful lot about inflation over the course of the last couple of years. My presentation to you last year was almost a third about inflation and the inflationary impacts we were seeing. And putting this chart back up from last year, you can see that spike that we experienced in headline inflation, up over 9% at one point several months ago. We have seen that rapidly come down. And more importantly, we have seen the core measure of inflation come down. Core excludes energy and food. Those are 2 volatile areas. And yes, they're meaningful. Yes, we all pay dollars at the pump. Yes, our grocery bills are significantly more expensive now than they were before. But in terms of determining the pace and direction of inflation, it's important to understand those core, or even more so, the sticky elements of CPI. And that's what's also up there on this chart. Those sticky elements of CPI show that excluding shelter, which has a significant lagged impact, so those changes in home prices that we measure as owner's equivalent rent typically have a very long trail to their impact in the headline rate of inflation. We exclude those, and we're now down to about what our post-1990 average is for the rate of inflation. We exclude all of these little pieces. But it's important to understand that the absolute price change, and we can talk in percentage terms all we want, but the absolute price change that we've experienced, especially as it relates to certain categories that impact us in the pocketbook for inflation, has been significant. In the post-COVID period, so measuring from February of 2020 through the last inflationary result, we can see that certain areas of inflation have spiked significantly. I already mentioned food. We can talk about energy, shelter, used cars, for example. Areas that we have seen rise in value significantly in that period. If we compare that to the 10 years before COVID, we can see that those absolute price changes, that val column, if you're paying attention to the chart, is about the same as it was in the 3 years since COVID. So let that sink in for a second. The amount of price change, the amount of inflation we've experienced economically in the last 3 years is equivalent to the prior 10. 3 years, 10 years, that's a lot of inflation to stomach over a short period of time. That has been economically impactful to the American consumer, and we'll see that in a little bit more detail here. Since January of last year, though, so comparing January to January, we have seen a marked change in those rates of inflation. We have started to see the headline rate of inflation decline. Even including those volatile food and energy areas, it's running at about an annualized 3%. Services has now taken over for goods in terms of the driving force of price change. Services has trailed since the onset of COVID, all the way up until the midpoint of last year. So it's changing, but it is definitely slowed. Another Jimmy Buffett quote, "We're the people they couldn't figure out, we're the people our parents warned us about," aptly describing the state of the American employment markets. Unemployment currently trends at 3.7%. That's the same level of unemployment we saw in 2019 before the onset of our pandemic-oriented recession. You can see that spike in unemployment we experienced in 2020, and it's leveled back out. But importantly, that orange line is above the purple line, meaning the number of job openings remains in excess of the total number of unemployed persons. That's taking every person that makes up that 3.7%, putting them into a job. We would still be 2.5 million people short of what American businesses demand from an employment perspective. Now, this is not the gulf that we experienced just a year and a half ago when it was over 12 million, but it is a continuation of a trend that has been in place since 2015. This is not a pandemic issue. This is a growth of the American economy issue. The American economy has been growing for a number of years by throwing people at the problem. We can either get better about how we make stuff, get more efficient, increase productivity, or we can add more people to produce more things. And by and large, the quick answer, the easy answer, the fast response answer has been add more people. And we crossed that point of inflection in 2015 where our demand for labor exceeds the available supply. Labor force participation, not so much the issue. Yes, we've leveled off in the upper 62% range. We used to be in the mid 63s. That's about as good as it's going to get. We've seen a wave of early retirees, similar to the wave we saw after 08 and 09. And that recession, we saw a wave of those Americans that if you were laid off, let go, or had your job prospects diminished in some meaningful way in 2020, and you were close to retirement age, especially given the rapid recovery in the stock market, you've resolutely said, enough's enough. I don't need to work anymore. We thought that number was about 800,000. It is now up to 1.3 million. That's a big change in terms of the makeup of the labor force. Total size of the labor force, though, is larger than it was before the onset of the pandemic. So as the population has grown, the labor force has grown, we just aren't participating as much. That middle chart tells us that we're not going to get a lot of bailout or a lot of help from people coming back to their jobs. That's labor force participation for the core working age demographic, those who are 25 to 54. That age group is participating in the labor force actually at a rate that is near a 40-year high. A couple months ago, we were at 83.5%, which was in fact a 40-year high in that rate of participation in the core working age demographic. So we don't have a bunch of people still operating Etsy stores waiting to come back to the labor force. Another Jimmy quote, I must confess, I could use some rest. I can't run at this pace very long. And yes, the American employment markets have been quite strong. But we are starting to see some cracks emerge that are telling us that they can't keep up this pace forever. Most notably, we have seen that pullback in job openings from 12 million. We have also seen pullbacks in the quits rate. That's the voluntary quits rate, people voluntarily quitting their jobs. A theme we talked about last year was people leaving and getting large raises, big changes in their base salaries. Not happening anymore. At the same time, the hiring rate has actually fallen off. American businesses aren't hiring as much as they used to. And at the same time, you would think in a tight labor market, wages would be going up. That was our experience in the 1970s. Wage push inflation started a secondary push in inflation in the mid-1970s, thanks largely to sticky wages. Wages are down to about their average. Now, this is wages and salaries, so it's counting bonuses and commissions and the like. We can see that on an average hourly earnings basis here on this next chart, looking like economists like to do it. Percentage changes. We have seen meaningful, and I mean meaningful, declines in the rate of change for many of these categories. For example, we have seen a fall off in job openings of nearly 27%, a 22% decline in the quits rate, a 17% decline in the rate of hires, and at the same time, the real change in wages, so adjusted for inflation, the real change in wages over this entire time period from when the Fed started moving rates higher to now is less than 1%. So we're not making more money. Businesses aren't hiring. People aren't quitting. Even layoffs have fallen off. We saw those layoffs were a big news item in the fourth quarter of 22 and the first quarter of 23, largely driven from the tech sector. Those have largely stopped. The on-the-run month-over-month rate for layoffs is only about 1%. That is a 45-year low. Businesses are resolutely hoarding employees. They're not letting them go. They're not quitting. They're not hiring. They're just sitting on what they've got. So the employment markets can't continue at their current pace for much longer. I'm just trying to get by being quiet shy in a world full of push and shove, aptly describing the American consumer. With all of this noise going on in employment markets and inflation, the American consumer continues to put their head down and move forward. We saw this number updated last week, a significant jump in the University of Michigan's Consumer Sentiment Index. We have talked about this number over the course of the last year and a half, really being quite a troubling number in terms of the future direction for the American consumer. Generally, we don't buy things when we're very pessimistic about the current or future conditions of the economy. And with the jump we experienced in last month's reading, the American consumer is sort of getting out of that malaise of things are really bad. And wait a minute, maybe they're not as bad. We've still got jobs. We've still got wages. Inflation's come down. We haven't dripped into a recession. Things are looking all right for the American consumer. And the story here is it's better than it was in the summer of 2022. It's not quite as good as it should be. I'd like to see the headline number above 90, for example, but we are on our way there. So the American consumer's sentiment has recovered to a great degree. American businesses, and here we'll separate services from manufacturing because they're experiencing very different impacts in the current economy. This is the ISM Purchasing Managers Index. Numbers above 50 indicate expansion. Numbers below 50 indicate contraction. The services side of the economy is still in a marginal expansion. Call it getting by. But if we tear this number apart and looked at backlogs, looked at new orders, we could start to see those are starting to fall off a little bit for services businesses. For manufacturing, they have been in 14 months of contraction. They experienced their highest number in the PMI survey in 26 years, just a year ago, but over the course of the last 14 months have been resolutely falling into contraction. So times are a little tougher for manufacturing-oriented businesses. Why? Those huge orders we saw in 2020 and 2021 have largely dried up. Those backlogs are gone. Many of the supply chain issues are no longer a concern. Whether they're still occurring or not, the orders aren't there to support the rapid increase in producer prices. Small businesses, too, are showing us that there is a bit of a pinch. We would like to see small business optimism at a nice, robust number. In fact, it sits today at about the level it was in the middle of 2020. Small businesses are not confident about the direction of the American economy. That's resonated in their percentage of expansion. On average, 15% of small businesses at any given time are planning expansion. That's organic or inorganic growth. We were actually above 30 before the onset of the pandemic. We're now at 5. Only 5% of small businesses are planning some sort of expansion. Either that's capital improvement programs, acquisitions, or the like. They're largely standing pat and trying to get by. And that's reflected in their outlook on business conditions. Business conditions for small businesses have reversed. The cost of debt has soared significantly. The American consumer, while they're still out spending money, are not really buying a lot more things. And the competitiveness of the small versus the large has continued to grow a gulf between them. The largest of the large in the American business world continue to soak up more and more of the activity. What's up with this recession? You probably asked me that question after last year's half-hearted attempt to predict one. I refuse to participate. And the American consumer absolutely has refused to participate in anything resembling a recession. Retail sales are up significantly. In fact, this number was just updated last week. The update that we received tells us now for the first time on a real inflation-adjusted basis that we have spent more money on a year-over-year basis. For 14 months, that had been negative on a real inflation-adjusted basis. Retail sales have been positive the whole time. Why? We were spending more money but buying the same amount of things. That's the impact of inflation. Things just cost us more. We went out and spent that more money. We didn't buy less things. But now, in the last observation, taking into account this last holiday season, we actually did buy more things, and we paid more for them at the same time. How are we doing that? Because in 2022, we crossed over an inflection point where we are spending more than we're making. The rate of increase in incomes has not kept pace with the rate of increase in spending. You would think in this type of environment we would slow down, but no, the American consumer changes direction like a cruise ship, very slowly, very deliberately, and a very wide arc. So we have backfilled that with the use of savings. We had $4.5 trillion in savings after that first round of stimulus. We spent that down below $2.5 trillion. We got another round of stimulus taking us up above $4 trillion. We spent that down too. In fact, we spent that all the way down to $550 billion in savings, the same level of savings we were at in 2010 after the 08-09 financial crisis. Thanks to higher rates on deposits and savings, we have now ballooned that back up to about $850 million, but we are by no means at the $1.2 trillion we were at before the onset of the pandemic. At the same time, we've increased our use of revolving credit. So what does an American consumer do if you don't have the money in savings and you want to keep spending? You take out revolving credit, whether that's credit cards or other debt sources. This is not an 08-09 financial crisis type situation, or more directly 05 to 08 expansion of credit. On percentage terms, this is in lockstep largely with the increase in the population and supported by our increase in incomes. Indecision may or may not be my problem. And at this point, after months and months of decision, the Fed is at an indecision point. That stair step in the purple line that you see is the Fed's rapid hike of interest rates over the course of the last 18 or so months, including 4 successive 75 basis point hikes. I have to go back to early 1990 to find just one time the Fed hiked 75 basis points. They did it 4 times in a row during this hiking cycle. However, despite all of that monetary policy change, all of those increases in rates, they only became restrictive in July of this past year. Why? At that point, the federal funds rate exceeded the rate of core inflation. We finally got that federal funds rate to a point where it is more restrictive than the time value of money on a go-forward basis. So we've had 5.5 months of restrictive Fed policy. We need about 12 to 18 months to really start to feel it in the economy. From the first time the Fed acts, we need 2 to 3 years now because of the large amount of fixed rate debt. The Fed's policy changes don't impact the consumer nearly as fast as they used to even just 20 years ago. So where do we expect things to go from here? I had to re-pull this chart last night for all of you because it changed so much in the last week. A week ago, we looked at a 68% probability that at the March meeting, the Fed would start to cut rates, that they would be cutting rates 7 times this year, according to the futures market. Now we look at the same graphic, and while they are still predicted to cut rates by the end of 2024 6 times, the probability of them doing anything in March has fallen to just 40%, just in a couple days. Why? Those retail sales numbers and consumer sentiment numbers I shared with you earlier have now caused the market to take a pause and say, wait a minute, if the consumer is this healthy, if the consumer is still spending money, and the Fed hasn't impacted consumer spending with policy yet, they can't cut rates yet. In fact, they may be higher for longer again, in this sort of back and forth ebb and flow of higher for longer, which is reflected here in the movement in the Treasury yield curve, becomes the reality for markets on a go-forward short-term basis. I put this up. Normally we show you a yield curve. We show one curve and then another curve, and you look at the shift in the curve. Here we're looking at the daily change for interest rates in each of the different Treasury buckets. And at the top of the chart is short-term rates because we are inverted. Short-term rates are still higher than long-term rates. The bottom of the chart there, those brighter colors are long-term rates, and you can see over the course of the last 6 months a rapid rise in the 10 and 30-year Treasuries, and then a rapid fall in the 10 and 30-year Treasuries. This is the market ebbing and flowing on the idea of higher for longer. If we remember last fall, the idea of higher for longer was resolutely intact. The idea that the Fed was going to leave rates in the 5% range for some unforeseen period of time in a way to continue to tamp down inflation and slow the economy was becoming a reality that markets hadn't priced in. So the long end of the Treasury curve moved in concert with that. Then we get to the Fed meetings in November and December, particularly the narrative around the December Fed meeting, and you start to hear a lot of Fed participants talk about, we may have done enough. In effect, putting policy from hawkish to neutral. Moving back to a neutral stance on policy allowed the market to breathe and to realize that in 10 years, we probably won't have 5% rates. So we can pull that 10-year rate back, and that 10-year rate fell back into the 4s. It's come back up a little bit more recently, and that paints that picture that I just described in the last chart, where the market is starting to come back to the idea that maybe higher for longer is a bit more of a reality than we want to admit. Lost in all this, and I'll go back one slide to show this, the 2 blue arrows at the bottom are where the Fed in the middle of December predicted rates are going to be at the end of 24 and the end of 25. You can see the market, in effect, thinks the Fed is going to get to the 2025 terminal rate by the end of 24. The Fed says 3 cuts this year. The Fed also is hinting that those cuts may not occur until the end of the year and may just be getting us off the restrictive stance that they are on, not a we need to cut rates to stimulate the economy, which is what the market is telling us. The market at 6 or 7 cuts is saying the Fed will need to stimulate the economy this year. That would be an extreme about face from where we have been. I mentioned inversion. We went inverted on the yield curve quite some time ago now. And have lived in an inverted yield curve for a long period of time. Generally, the accepted rule is between 9 and 18 months from yield curve inversion, you get a recession. That's only about a 58% accurate indicator of recession. The more accurate indicator is peak inversion. Peak inversion occurred on July 3rd of last year, intraday at 109 basis points, end of the day at 108. That peak inversion measured forward 9 to 18 months puts us not quite into that 9 to 18 month window yet. So if this is an accurate predictor of recession and the peak inversion to recession is about a 76 to 78% accurate predictor of recession, that window hasn't occurred yet. In fact, if you want to do the math with me, that window occurs sometime between May of this year and March of next year. But there are impacts today for both consumers and businesses. Most notably for consumers, it's on the housing side of the economy. So as mortgage rates have gone up, we have seen a commensurate fall in existing home sales. Makes sense. Borrowing rates are higher. People don't want to buy houses. But curiously, we've seen new home construction stabilize at or slightly above its 20-year average. Well, how does that happen? People aren't buying existing homes, but they're still buying new homes? What's actually occurred here is a bit of a shift, and we can see that shift occur in prices. Prices for new homes have fallen about $60,000 to $90,000, depending on what part of the country you are in. Prices for existing homes have barely moved, about $20,000 on a national average. So people that are buying existing homes are still paying the same price. Also curious, because if sales fell off and demand fell off, you would think that price would correct, and it hasn't. Why? This is not a demand situation. This is actually a supply situation. Still caused by higher rates, but the supply situation is this. Similar to what we saw coming out of 2020 and 2021, when people just didn't want to sell their houses, and we saw average homes available for sale down to 2 months as opposed to the 6-month average. We now sit at 2.6. Why? If you're an empty nester, if you now have a 4-bedroom, 2.5 bath house, 2,500, 3,000 square feet, big house, and you refinanced your mortgage 2 years ago at 2.75%, and your dream was to move to Florida, sit in a condo, enjoy your retirement. The reality is, not only has Florida real estate gone up by 38% during that time frame since you refinanced, but your borrowing costs nearly tripled. Do the math on that type of purchase for a similar cost condo in Florida. You actually pay more in your mortgage for making the move and downsizing than it costs you to stay in the home you're in. So people just aren't selling their houses because the replacement cost of moving out of their home is too high. So it's a supply issue in the housing markets, not a demand issue. Now, supply issue keeps and persists, we will have a demand issue that follows it. On the business side, much more straightforward, much more clear cut. Business lending rates up on average to 8.5%, following that stair-step movement of the Federal Reserve. Capital expenditures fell off a cliff. Now, I'm measuring this from the end of 2019 forward to today, and we have seen, if you're looking at that, that's not a misprint. It's an 80% decline in capital expenditure for businesses. Even more so if I measured it from the peak, because we were up 65%. In the era of free money, PPP and the like, post the pandemic-oriented recession, capital expenditure in America shot up by 65%. It's now down 80 to 90% from where we were at the end of 2019. Businesses just aren't investing in the business. Cost of debt is too high, or they're pushing pause. We see the pause being pushed more immediately in real estate projects, but as businesses look for capital expenditure projects, they may have that capital, and they say, I'm going to sit on this capital for now and wait and make sure that the health of the business is okay, that we don't slip to recession, that there isn't an economic slowdown that I have to account for, and I don't want to have committed all of that money into a large capital expenditure project and all of a sudden have a balance sheet that is bereft of assets. Another Jimmy quote, where it all ends, I can't fathom, my friends. If I knew, I might toss out my anchor. I may have mentioned to you all before, I get to sit in the ivory tower of economics and not pick a political side, but I do get to make political observations. And while I don't know where things will end here in an election year in 2024, there are a couple observations. Number one, and this is just a quick observation, preempting what I think will be a question from someone in the audience, the cost of debt in the United States. The federal government expects it to rise by 0.4% year over year, fiscal 22 to fiscal 23. The real cost there is about 2.2%, so they have massively underestimated the amount of expense necessary to maintain the federal deficit and spending. But the more worrisome political item is polarization. And some poor researcher at UCLA sat in a dusty basement, earning their political science degree, thinking they were going to be surfing, when they're actually tabulating every vote made in Congress back to the mid-1800s. Now, I can guess most of those are not digital. Most of those are not even on microfiche. They're probably in dusty books. Imagine that meeting with your professor. You go in, hey, I'm going to surf this afternoon, but what can I do for you? No, you're not. For the next 3 years, you'll sit in that basement, tabulate votes. So he did that, so I can put this chart up here for you and show to you that even in the post-Civil War period, Congress wasn't as polarized as it is today, meaning votes strictly down party lines. That leads to potentially inaction. Now, normally markets would like Congress to stay out of the way. Stock market performs 3 to 4% better annualized when the government is in divided control. Why? We don't get new regulation. We don't get major changes to tax code. Government stays out of the way, market flourishes. Government gets in the way, market returns are less. In an election year, though, we typically see lower returns in the first 3 quarters. as we deal with uncertainty, and as we deal with any sort of opacity to political platforms, we need some certainty. Markets like certainty, they hate uncertainty. In the fourth quarter, you get certainty, because after November, we have one party that is now either in unified control of the government or there's divided control of the government. We know what policy items are going to be brought to the forefront, and you get a sector-based rally in the stock market. Think of it this way. If you get less regulation, financial services usually does pretty well. If you get more spending for the future health of Americans, healthcare does pretty well. Policy makes a difference. Now I'm going to ask the audience a question. Question and answer period is coming up very, very shortly, but I get to ask you a question first. Does anyone in the room know the last time we have elected a president to a second elected term when there's a recession within 2 years of election day? Any guess is a good guess. Feel free to blurt it out. 1975, Carter. 84, that'd be Reagan. No, those are both wrong. Any other president name guesses? Washington. Way too far back. We did it once before Washington. Somebody always guesses Roosevelt. Nobody guessed Roosevelt. That's also wrong, but just nobody guessed Roosevelt. I was a little sad nobody guessed Roosevelt. Last time it actually happened, 1900, William McKinley. Yes, we re-elected Teddy Roosevelt, we re-elected Calvin Coolidge, but both of them were not elected to a first elected term, if you paid attention to the way I worded my question. Second elected term. Roosevelt obviously took office from McKinley when McKinley was assassinated. Coolidge assumed the office when Harding had medical complications and passed. But the last time we elected a president to a second elected term when there was a recession within 2 years of election day was William McKinley in 1900. That is to say that if there's a recession before election day, whoever's in charge usually gets blamed. And it's usually not a good result because it gets others to the polls to vote against them. So Roosevelt and Coolidge likely got reelected because they weren't blamed for the recessions that occurred during their presidential terms. Their predecessor likely was. But that's an interesting takeaway because will politicians be more engaged in the process to try to avoid recession in an election year? And your answer is generally yes. Last Buffett quote and a picture of Warren and Jimmy together. They were actually friends, had bonded over some charitable interests they both had, and had both spent a good chunk of their lives engaged in charitable pursuits. Come along, let's have some fun. The hard work has been done. And your hard work is done. No more tiny charts. No more economists speak. Just a couple of observations and conclusions to be drawn. First, observations. In my view, the global economy, not just the American economy, the global economy is held up pretty well. Particularly what it's gone through over the last 3 years. Inflation here in the United States certainly has been fading, but the concern of inflation is being replaced by other things. Supply and demand shortage in labor markets, cost of borrowing for consumers and businesses. Central banks are unsure if they've done enough to fight inflation. Here in the United States, that's becoming much, much more certain. In other parts of the world, if you heard the releases from the Bank of England, the bank and the European Central Bank over the course of the last 3 weeks, there's a little bit less certainty on whether their fight against inflation is over. Leaves me with 3 questions. How much will the economy slow from policy tightening and when? Because we haven't seen any economic slowness from policy tightening yet. Have we seen the last of inflation? Or does the Fed still have a battle to fight? Are we in for a redux of the 1970s where we get 3 inflationary spikes over the course of a 12-year period? And is the Fed in control? Or have events that happened in 2023 really taken over? My observation is this. Odds of a soft landing have increased, but a short, shallow recession still remains likely if we look at the totality of the economic picture. That may and is not likely to occur at the beginning of 2024. That may not even occur at all in 2024 as the American consumer continues to just ignore every economic warning sign and march forward with spending. The last mile for inflation is going to take time. So that last 1% to get us from 3% down to 2%, which is the Fed's target, is going to take a long time. In fact, if you pay attention to what the Fed has said over the course of the last 2 months, they're content to leave us at 3% annualized rate of inflation if it means that the economy continues to move forward at its current rate. Getting back to 2% is not going to be a 2024 and maybe not even a 2025 occurrence. In the instance where they leave us at 3% from a policy perspective because they've cut rates, that may not even be a 2026 reality. And the Fed has its hands on the wheel. There's still policy the Fed can implement. We haven't even talked about the Fed's balance sheet, which is trillions of dollars in size and has a policy tool that they can act on. But road conditions are unpredictable. There is a lot of uncertainty going forward from here, and that uncertainty causes a lot of angst for the short term. However, and last Jimmy Buffett quote for you, this is from the song Bubbles Up. It was on his last album that happened to be released after he passed. It's a scuba diver concept. If you get disoriented underwater, follow those bubbles to the surface. They're going to lead you back home. And like those bubbles for a scuba diver, we can be assured that on a go-forward basis, the American economy is well set to continue to grow into the future. 2024 may be a volatile year. There may be a short, shallow recession in the cards in the next 18 months or so. In none of those instances are they economically destabilizing for the future of the American economy, nor in the medium term is there a prospect where the American economy slips away from the 2.5% long-run growth that we have experienced over the course of the last 2 decades. So with that, I thank you for your time, attention, and as last time you are speed readers and read all of my disclosures, so my compliance department is happy, we are happy to open it up to the question and answer portion at this time.
And if you have a question for Jason, you may ask a question using this microphone here. And as always, please keep your questions topical and concise. Thank you.
Thank you. That was very, very interesting. What effect do you think that technologies like AI and other advances that seem to be happening very quickly will have on the welfare of the stock market and the economy in general?
Excellent question. So the question around the impact of technology and AI on the economy and the stock market on a go-forward basis. More directly, AI has certain implications for large American businesses in the technology space. We've already seen stocks run up. These magnificent 7 stocks, many of which have been driven by their investment in AI, will continue to be an ongoing observation. Goldman Sachs has done some work on the expanse of AI, and there's some 250 to 300 stocks currently traded today across major exchanges that would be exposed in some meaningful way to AI, and not all of them have jumped. So there is a path to growth from an AI perspective in the stock market, certainly, because it will change the way businesses do things. Now, technological change doesn't happen overnight, and that's the important observation. That's not to say in 2024 we're going to see employment markets completely upended because AI will take over and nobody will have jobs anymore. That would take a long, long time to happen. So economic impact, slower, but more deliberate. Market impact can be much more rapid, and we are likely to see a continuing bubble grow within AI stocks over the course of the next year to 18 months. Now, I resolutely use the word bubble. So to remind you of what happened with internet stocks back in 1998 and 1999, this looks awfully similar.
Thank you. Excellent program. I don't think you've said anything about the problems with shipping in the Middle East or the possibility of an expanded war.
Yes, geopolitics certainly plays into those turbulent road conditions that I alluded to in my conclusion. We saw geopolitics impact the economic picture when Russia invaded Ukraine. While we are not large consumers of Ukrainian grain, the rest of the world is, and it is a major impact for those countries economically speaking. Now, shipping disruptions in the Middle East have been an unfortunate reality since we started to see activities of Somali pirates impact shipping in the Middle East some 15 years ago. Now, those have ramped up significantly over the course of the last several months and continue to be a concern for businesses. The real cost to a business for avoiding the Red Sea and shipping around the Horn of Africa is a 3x increase in shipping time and nearly a 2 to 4x increase in shipping cost. So avoiding the area is an economic game changer for those businesses. Right now, they need to think through the inflection point. They need to think through the cause. And like most of the rest of the world, a quick resumption or a quick quelling of hostilities and lack of resumption or spreading of the conflict would benefit the global economy. In the short term, we have to accept that there is levels of destabilization and the shipping costs will be higher in the short term.
So a related question, is there any trends or indications on onshoring manufacturing, bringing manufacturing back?
Yes, there has been a path being tread by American businesses over the course of the last 3 years, thanks partly to legislation and partly towards business decision-making, given the supply chain disruptions we saw in 2020 and 2021, to start onshoring production, particularly of small, what we call dumb chips. Those that would be chips that go into washers, dryers, refrigerators, things that are necessary for the electronic world we live in, but don't get the flashy Intel pictures of the Intel inside and the guys in the white suits with the little robotic arms. One is coming online in the Phoenix area early this year. There's another that has been proposed to be built in Washington State. So we are starting to see a trend emerge for American businesses to onshore. In onshoring, they're accepting a higher level of expense. So that means margin compression. This margin compression we saw over the last 3 years. If you agree with the idea of onshoring and bringing it home, you're also agreeing to slightly tighter margins in that process.
And last year we saw a growth in labor militancy, or at least strike activity. Do you think that that's hit its peak, and what are the macroeconomic consequences of what's going on there?
If we look at the strike activity, particularly the UAW strike at the end of 2023, the back half of 2023, from an broad economic perspective, there wasn't much of an impact. We saw about a 1.3% jump in auto sales, auto production, in the most recent manufacturing numbers here for the last month. After that strike resumed, we sort of caught back up. And generally, that's what we see with strikes. Strikes and government shutdowns, so I'll lump that into the mix as well, even though we keep finding a way to kick the can down the road on a government shutdown. Either one of those things destabilize economic output in a very, very short-term viewpoint, and then when it is resolved, there's a catch-up period. So the only real economic destabilization over a medium-term period from a strike action would be if that strike carries well over your short time window of 4 to 6 months and starts to become economically impactful in terms of businesses' survivability. So do I anticipate that to be an ongoing factor or a challenge for the economy? Likely no. Even if we are likely to see a higher incidence of organized labor activities over the course of the next couple of years, partly because of the success of the UAW strike most recently, but also simply because with wages not moving and employment markets continuing to be tight, workers need a way to express their displeasure at wages, and organized labor, that's typically a consolidated effort and usually ending in a strike action.
My uninformed opinion, or my uninformed impression, is that the United States has had a better experience with inflation over the last couple of years than both the rest of the developed or undeveloped world. So 2 questions. Is my impression correct that we've managed weather this better? And if it is, do you have an opinion as to why that's the case?
Yes, the American experience has been better than the UK, been better than Europe, whether developed or emerging areas of Europe, has been better than most of the emerging world. Couple exceptions. Japan is a notable exception because they spent 20 to 30 years in deflation. And China, which is on the opposite end of an economic cycle than the rest of the world. They implemented different COVID control lockdowns. Their economy behaves differently than the rest of us. They are in a different part of the cycle. So they did not experience the type of inflation we did here. But why did the American economy, one, not peak as high as Europe and the UK, and 2, why did we recover so quickly and so directly when they have had much more of a choppy recovery from inflation? It partly aligns with where we sit within supply chains, especially for the emerging world, but where we sit within supply chains is a meaningful indicator. Why? Because the inflationary spike we saw is primarily driven by supply and demand imbalance. It wasn't driven by policy. It wasn't a policy decision. It wasn't policy that got us out of it. It wasn't policy that got us into it. It's simply just supply chains. So supply chains disrupted as a general consumer here. Once we were able to consume things again, we were pretty quickly able to put inflation behind us and move forward. Also, because there were no other economic destabilizations here in the United States, we didn't deal with higher interest rates. We didn't deal with the impact of some other geopolitical force. We were able to put ourselves on a direct path to recovering from inflation. In Europe, where some of your inflation was tied to change in energy prices because of the Russia-Ukraine conflict, you were divorced from the idea that you could solve the supply chain and move forward. In the parts of the emerging world that needed grain supplies from Ukraine, again, they were not able to divorce themselves completely from geopolitical influence in their inflationary path. So the American economy is more insulated, the American economy is a little more protected, and as such, had a more direct route to solving the inflation puzzle.
Thank you. You talk about wages and inflation, and what about economic stability and the way people are feeling comfortable about their future? Generational wealth, retirement wealth, readiness for retirement, and politically, people talk about an economic civil war because there are people who just feel that even at a higher wage, they don't have a future. What's happening both in the U.S. and then worldwide with regard to that?
Yeah, a good question, and I think what your question gets to is the idea that we measure economic health on this concept of GDP or gross domestic product. How much do we produce as a nation? Yeah, we produced a lot of stuff. The reality is that there is a growing gulf in where the consumer sits and who consumes what we produce, or what the rest of the world produces, since we're the world's consumer. In that type of picture, in that type of environment, we're not really measuring economic health as a happiness indicator. We're measuring it simply as we built stuff. If we measure it on a happiness basis, we start to throw in some areas of the soft science, if you will. That idea of consumer sentiment. And while the consumer sentiment has improved, thanks largely to current conditions being better than what we expected them to be, our outlook has always been pessimistic. If we go all the way back to that slide in consumer sentiment, and you look at that level of sentiment for future economic conditions versus current conditions, future conditions are almost always lower than current conditions. Why? We tend to be a little pessimistic about where we're going as an economy. That plays into wealth disparity. It plays into a lack of productivity growth in the United States. Plays into, to some extent, a lack of population growth, leading us to an aging population. Those that are in their later years typically spend money differently than those that are in their earlier years. They're not as voracious consumers. It's why we've seen economic growth fall from 3 to 3.5% to 2.25% over the course of the last 2 decades, simply because the makeup of the country has changed. So if we look at those as factors, trying to add in soft observations into the economic picture is okay. It's not outstanding. It's not the 1960s, the 1950s that we saw this economic boom in the United States. It's not the 1980s that felt really great, even if it wasn't for some people. It's starting to see some level of inequality actually impact the economic direction of the country. And that is long-term concerning and short-term, unfortunately, glossed over. All right, and I think that brings us to the end of our... Thank you.